Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Corning.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we really jump into today's analysis, I do want to quickly mention StockOracle.
Right, yeah.
You can find a special 14-day trial link below in the description. Now, this is an affiliate link, so the channel may earn a commission at no extra cost to you.
Exactly.
But we want to be super clear here. StockOracle is an AI-aided stock research platform. It is not financial advice, it's not a trading signal service, and it's not real-time market data.
Yeah, that's a crucial distinction to make.
Right. And always remember that their AI insights and, valuation estimates can be incomplete or wrong. So important facts should always be verified by you.
Always verify, absolutely.
Okay, so let's get into the wealth building context for today. Because you probably know Corning, right? Like as the company that made the glass for Thomas Edison's light bulb.
Yeah, or, the invisible manufacturer behind the screen on your smartphone,
Right.
Gorilla Glass and all that.
Exactly. But according to our research today, and today is July 28, 2026, by the way, this 170-year-old specialty glassmaker is, well, it's actually acting as the central nervous system of the artificial intelligence supercycle.
Which is just wild when you think about it.
It really is. So our mission today is to unpack this setup because their Q2 earnings report drops literally tomorrow.
Right, tomorrow morning.
Yeah, and we need to figure out if this presents a generational opportunity or, maybe a dangerous valuation trap. We are not telling you to buy, sell, or hold here, but we are going to look closely at both the upside and the downside.
Yeah, the stakes here are just fascinating because Corning isn't just making passive glass anymore. They've quietly morphed into this $125.5 billion industrial giant.
$125 billion, that is massive.
It's huge. And they are positioned right at the bottleneck of the massive capital expenditure boom we're seeing from basically every major tech titan on the planet right now.
Right, the AI data center build out.
Exactly. To understand their current valuation, we really have to completely reframe how we think about their core product.
Okay, so let's unpack this. If we look past the daily AI hype cycle, the chips and the chatbots, and we focus directly on the fundamentals, the tailwinds are massive.
Oh, absolutely massive.
Our analysis shows their trailing 12-month revenue growth is sitting at a really robust 20.05% year over year.
Yeah, and you just rarely see that kind of compounding growth in a legacy capital-intensive manufacturing business.
Right. Usually those companies are growing at like GDP levels, 2, maybe 3%.
Exactly. But Wall Street is anticipating that this momentum is going to hold. They've bumped the Q2 earnings per share consensus up to 76 cents just ahead of tomorrow's print.
So 76 cents is the number to beat tomorrow.
Right. And that growth, it's being driven almost entirely by their optical communications segment, which brings us to catalysts.
Yeah, the fiber optics.
Yeah. To understand why this segment is growing 20% annually, you have to kind of look at the physical architecture of a modern AI data center.
Well, wait, hold on. Let me push back on that for a second. Because we hear endless chatter about AI processors, right? And cooling systems and power generation.
Constantly.
Glass seems like an afterthought. What starts a tech giant with, I don't know, unlimited capital from just vertically integrating and manufacturing their own fiber optics to connect their servers?
Well, it comes down to the unforgiving physics of moving data at scale.
Okay, physics. Break that down.
So when we talk about these new AI data centers, we're talking about moving just unprecedented amounts of information with virtually zero latency.
Like instantaneous communication between thousands of processors.
Exactly. And you simply cannot do that over traditional copper wire anymore.
Because copper relies on electrical currents.
Right. And electrons moving through copper encounter physical resistance. They generate immense heat, and worst of all, they suffer from signal degradation over distance. It's like trying to force 1 million cars through a one-lane mud road.
Right, so you need photons instead of electrons.
Precisely. You need light. But to move photons across kilometers without the signal degrading, which is a concept called attenuation, you need highly engineered, ultra-low-loss optical fiber.
And that's where Corning comes in.
Yeah, because this isn't just a matter of, stretching out molten silica in some warehouse.
Right.
Corning has spent decades perfecting a process called chemical vapor deposition. They literally build the glass layer by molecular layer.
Wait, molecule by molecule?
Basically, yeah. They control the refractive index of the glass core at a microscopic level to ensure total internal reflection.
Total internal reflection, meaning The light bounces perfectly down the fiber without bleeding out into the surrounding material.
That is the exact mechanism, yeah. And if a tech giant tried to replicate that intellectual property from scratch today,
It would be a nightmare.
it would take a decade of trial and error just to match Corning's baseline manufacturing yield rates. I mean,
Right.
they hold patents on the specific chemical doping of the glass that allows these AI clusters to communicate at the speed of light.
Okay, that physical complexity definitely explains the impenetrable moat that our research highlights. I mean, they currently hold a massive 6x revenue advantage over their nearest competitor, which is Littelfuse.
Right, Littelfuse is a solid company, but in capital-intensive manufacturing, a 6x scale advantage is practically insurmountable in the short term.
These are the fixed costs, right?
Exactly. Corning can spread its massive fixed costs, the multi-billion-dollar fabrication plants, the specialized furnaces, over a much, much larger production volume.
Though the analysis does note that Littelfuse is seeing some recent momentum.
They are, yeah. But taking market share in a vacuum is different than taking it in a rapidly expanding market.
Ah, okay, so the pie is just getting bigger.
Right. The Littelfuse momentum actually validates the broader bullish catalyst here. It confirms that the total addressable market for optical fiber is expanding so fast that secondary players are just catching the overflow.
That makes total sense. And the macro environment is providing some serious validation for this pipeline, too. I mean, look at the partner data we got from just this past week.
Oh, Verizon, right.
Yeah, Verizon posted a Q2 beat and explicitly raised their 2026 outlook. And that carrier capital expenditure, it flows directly into Corning's order books. They're the ones actually laying down the physical network.
And Intel's recent print confirms the exact same trend on the hardware side. I mean, they posted 25% revenue growth driven by their Xeon server CPUs and AI PCs.
Wow. 25%?
Yeah, and every single time Intel sells a rack of AI servers, those servers have to be connected by optical interconnects.
Right. The glass.
The institutional money sees this pipeline clearly, too. Like, the Carillon Eagle Growth and Income Fund just released their Q2 letter citing their position in Corning specifically because of this rising AI fiber demand.
Okay, so if their telecom mode is this impenetrable, you'd think that's the entire investment thesis.
You would think so.
But here's where it gets really interesting. The research points to a secondary engine driving that 20% fundamental revenue growth that the broader market seems to be, well, kind of underpricing.
The life sciences segment.
Right. But I got to play the skeptic again here because we're talking about an industrial tech and telecom materials company.
Yeah.
How does a cell culture and bioprocessing division fit into this ecosystem? Like, is this just some legacy division they haven't bothered to spin off yet?
I get why it looks that way, but far from being a distraction, it is arguably a brilliant strategic hedge that leverages their core competency.
Which is material science.
Exactly, material science.
Right.
Corning is emerging as a leading supplier in the global cell culture and bioprocessing market.
Okay.
They manufacture these highly specialized vessels and bioreactors used to grow biologics, vaccines, and advanced pharmaceuticals.
But why can't a pharmaceutical company just use, I don't know, generic lab containers? Why do they specifically need Corning's glass or polymers?
Because living cells are incredibly fragile and highly reactive. If you try to grow sensitive biological materials in a standard, cheap plastic container, you run into this severe problem of leachables and extractables.
Leachables.
Yeah, microscopic chemical compounds from the container itself can literally seep into the biologic and ruin an entire multi-million-dollar batch of medicine.
Oh, wow. So they're basically applying the same precision they use to guide a photon to keeping a cell culture alive and uncontaminated.
That is perfectly stated, yes. That mastery of surface chemistry allows them to create perfectly inert environments. And they also engineer surfaces that actively promote cell adhesion and growth for specific types of biologic.
That's fascinating.
It is, and that level of reliability has secured them a massive foothold, particularly with expanding dominance in the Asia-Pacific region, which is seeing a huge boom in biomanufacturing right now.
Okay, but what does that do for the fundamentals on the balance sheet compared to the AI fiber side? Because optical communications is notoriously cyclical, right?
Right, exactly. Telecommunications and data center buildouts have massive boom periods of capital expenditure, like the AI wave we're in now, followed by digestion periods where orders just slow down to a crawl.
So life sciences smooths that out.
Yes. It provides high-margin, recurring revenue. This division gives Corning vital optionality.
Because biomanufacturing relies on single-use technologies.
Exactly. The consumable nature of modern bioprocessing is key. Instead of cleaning and sterilizing massive stainless steel vats after every batch, modern labs use single-use engineered polymer
So
vessels.
you use the vessel, you dispose of it safely, and you buy another one from Corning.
You got it. And that creates a safety net of steady, compounding growth just in case the telecom cycle experiences a sudden, unexpected slowdown.
And the operational leverage from that recurring revenue is really evident in the margins. The fundamentals note a trailing 12-month gross margin of 36.36%
That's huge.
and a net margin of 11.09%. I mean, you only get those kinds of margins in physical manufacturing if you have serious pricing power.
Which brings us right back to their proprietary IP. Pharmaceutical companies are just not going to risk a $50 million batch of biologics to save a few pennies on a generic container.
Right. It's a no-brainer for them.
Exactly.
Okay, so if the fundamental setup is this bulletproof and AI telecom moat combined with a high-margin bioprocessing safety net, the market should be pricing this stock for absolute perfection.
You'd assume so.
But we need to look at the technicals, because the chart is telling a completely different, almost contradictory story. It looks like Wall Street doesn't believe the narrative at all.
The chart is definitely messy right now.
Yeah, at the time of this analysis, the price is $143.36, which is 47.3% below its 52-week high of $271.78.
Yeah, a near 50% haircut from the peak definitely sounds alarming on the surface. But we really have to zoom out to the broader secular trend to understand the mechanics of this sell-off.
Okay.
The stock is currently in a 13-week corrective phase, down roughly 13.1% over that specific window.
So how does a stock drop almost half its value, but still maintain what the analysis calls an intact secular uptrend?
By looking at the origin of the move.
Right.
Prior to this 13-week correction, the stock rocketed from its 52-week low of $54.89 all the way up to that 271 level.
Wow, from 54 to 271.
Yeah, that is a staggering 394% run over a 12-month period. So even with this massive pullback we are seeing, the stock is still up 67.49% year-to-date.
Right, so the initial breakout simply ran too hot too fast, and now the market is just digesting that parabolic move.
Exactly. A 47% pullback brings the stock to roughly the midpoint of its 52-week range. And for trend-following institutional investors who missed the initial breakout at $55, this level represents a highly logical accumulation zone.
Because they wait for the initial hype to cool off, and then they step in at the midpoint.
Right, and our technical analysis points out a critical bullish divergence in the sentiment and trading volume that really supports that accumulation thesis.
What's the volume looking like?
So as the price has been dropping over the last 13 weeks, the trading volume is steadily contracting. Currently, it's running at just 0.77 times the 3-month average.
Okay, so volume is drying up on the way down.
Yeah, and that volume contraction is one of the most positive technical signals you can ask for during a steep correction.
Think of trading volume kind of like the fuel in a car, right?
I like that analogy.
The stock price has been driving downhill for 13 weeks, but the volume contracting means the car is running out of gas.
Right.
The downward momentum is stopping because the eager sellers have simply run out of shares to sell.
That is a highly accurate way to look at the market mechanics here. There is no panic selling.
Right, no capitulation.
Exactly. We aren't seeing forced liquidations or margin calls cascading through the order book. The sellers who wanted to take profits after that 394% run have mostly just stepped aside now.
So the price is just drifting lower under its own weight, waiting for the next fundamental catalyst to bring the buyers back.
Yes, with tomorrow's earnings report being that exact potential catalyst.
Okay, but we promised to look at the whole picture here. We have to dive into the risks in the bear case.
Always. You have to stress test the thesis.
Because if the fundamental setup is this strong and the technical pullback provides a great entry point on exhausting volume, what is the catch? Let me throw the biggest red flag from the data at you.
Let's hear it.
If the AI and life sciences stories are so robust, why have company insiders net sold over 305,000 shares in the last 90 days?
Yeah, that's the number.
I mean, we're looking at negative sentiment from the inside. 23 insider sell transactions versus only 11 buys.
I know. And on paper, a 2-to-1 ratio of insiders heading for the exits looks terrible. It's usually the first thing retail investors panic over when they check the sentiment data.
Oh, for sure.
But we have to contextualize the absolute numbers against the massive size of the entity. Remember, Corning is a $125.5 billion company. In that context, 305,000 shares is effectively a rounding error.
But they're still selling, right? In finance, we usually rely on a simple mental rule of thumb. Insiders sell for 100 reasons. Buying a house, paying massive tax bills, basic portfolio diversification, but they only buy for one reason. They think the price is going up.
That is the perfect framework to apply here. Just remember that 394% run we just discussed.
Right.
If you are a senior executive whose compensation is heavily tied to stock options and your company's stock quadruples in a single year, you're going to take some chips off the table.
It's just prudent financial planning.
Exactly. It signals routine profit-taking after a multi-bagger run, not a desperate mass exodus from the boardroom. And honestly, the fact that we still see 11 buy transactions at these elevated levels shows some insiders still see significant upside remaining.
Okay, fair enough on the insiders. But the genuine operational risks seem to lie outside of the executive suite, specifically in their automotive segment.
Yes, the auto sector.
Our research explicitly flags this division as the primary vulnerability going into tomorrow's print.
It is. The global automotive sector is facing distinct cyclical headwinds right now, and generally soft consumer demand, particularly with the really uneven transition to electric vehicles.
But what exactly is Corning supplying to the auto industry that makes them so vulnerable to a broader manufacturing slump? I mean, we all know they make Gorilla Glass, but this isn't just about infotainment screens, is it?
No, it's actually about emissions. They manufacture highly specialized emissions control products, specifically gasoline particulate filters, or GPFs, and complex ceramic substrates for catalytic converters.
Oh, I had no idea they made those.
Yeah, and as global auto manufacturing slows down, particularly with fluctuating internal combustion engine sales in major markets like China and Europe, the demand for these high-margin substrates drops proportionally.
So if the car market is slowing down, the risk tomorrow is that a larger-than-expected shortfall in the automotive segment drags down the overall bottom line.
Exactly.
And it could completely offset the incredible growth they are seeing from optical communications and life sciences.
Which brings us directly to the real valuation danger here. Corning is currently trading at a 69.36 times price-to-earnings ratio and a price-to-sales ratio of 7.69 times.
Wow. 69 times earnings. Those are multiples you typically see for, like, hyper-growth software companies, right?
Yeah.
Not 170-year-old industrial manufacturers.
Right. The market is clearly pricing in massive, sustained future growth.
So if optical growth misses expectations by even a fraction, or if that automotive slump drags the bottom line down too heavily, that 69x multiple offers absolutely zero downside support.
Yeah, this is the classic risk of multiple compression.
Explain that for a second.
So, when a growth narrative stumbles at these extreme valuations, the market doesn't just lower its forward earnings estimates, it refuses to pay a premium multiple for those earnings anymore.
Right.
So mathematically, if the market decides Corning should trade at a, say, 30x multiple instead of a 69x multiple, the stock price essentially gets cut in half, even if their actual earnings stay perfectly flat.
And given the short-term sentiment is already negative, I mean, the price is down over 4% just in the last 5 days, a miss tomorrow could easily break technical support and extend this correction down toward the $100 to $120 range.
Absolutely. We are weighing generational AI tailwinds and biological material dominance against a sky-high valuation and a lagging automotive division. It's a delicate balance.
So let's get to the final verdict. How does the analysis balance these conflicting signals?
So the system assigns a bullish score of 7.5 out of 10.
Okay, 7.5.
Yeah. The overarching investment thesis is that the current setup is a high-conviction accumulation zone. At $143 a share, sitting 47% below its highs, with the selling volume clearly exhausting itself, it presents an optimal swing trade opportunity going into tomorrow's Q2 earnings.
The expectations for an earnings beat are heavily supported by the macro capital expenditure signals we saw from Intel and Verizon, right?
Yes. If they beat the 76-cent consensus, and more importantly, if management raises their forward guidance specifically on the AI optical fiber demand pipeline, this stock could experience a very sharp, violent reversal of this 13-week correction.
And the research notes that if that guidance hits, this setup transitions from a quick swing trade into a multi-quarter hold. So the long-term view is very strong.
Definitely. If the forward guidance confirms that the AI capital expenditure supercycle is accelerating through Q3 and Q4, you want to hold through that confirmation cycle.
Right.
And when you add in the life sciences expansion in the Asia-Pacific region, quietly re-rating their profit margins over the next 12 to 18 months, the long-term thesis remains highly compelling despite those immediate valuation risks we talked about.
Well, it's a fascinating inflection point for a company that has reinvented itself so many times over a century and a half. Before we wrap up, don't forget to hit that subscribe button if you enjoyed today's analysis.
Yeah, please do.
And again, if you want to explore these kinds of catalysts yourself, check out the StockOracle link in the description for that 14-day trial.
Just remember, do your own verification.
Exactly. I want to leave you with a final thought to chew on before those earnings drop tomorrow.
Let's hear it.
We talk endlessly about AI data centers demanding exponentially more power and, faster processors. But over the next decade, as these processors get impossibly fast, could we reach a physical bottleneck where the specialty glass and the optical materials connecting these processors become more valuable and, honestly, harder to replicate than the processors themselves?
It's a real possibility.
When photons become more important than electrons, the legacy company making the glass might just hold the keys to the entire technological kingdom. Something to ponder as you watch the tape tomorrow morning.